Most LLC owners are leaving $15,000 to $50,000 in tax savings on the table every single year, and they don't even know it. I'm Robert Lawson. I spent years as an IRS agent before becoming a CPA, and I've helped my clients save over $8 million in completely legal tax strategies. And in my experience reviewing hundreds of LLC setups, the pattern is always the same. Entrepreneurs set up their LLC, they start making money, they file their taxes, and they walk away thinking they are done. They're not. They're just overpaying. Today, I'm showing you the hidden tax benefits that are actually written into the tax code, benefits that the IRS expects you to claim if you know they exist. By the end of this video, you'll understand exactly how to structure your LLC to minimize your tax liability legally and keep more of what you earn. Let's start with the biggest misconception I see. Most people think that forming an LLC automatically gives them some magical tax benefit. It doesn't, not by itself. An LLC is a legal entity, but from the IRS's perspective, an LLC is a pass-through entity. That means the LLC itself doesn't pay federal income tax. You do, the profits pass through to your personal tax return, and you're on the hook for the full amount. Here's where most people get it wrong. They think that's the end of the story, but it's not. The magic isn't in forming the LLC, it's in understanding how to legally minimize what those pass-through profits actually are. In my experience, when I reviewed a client's LLC last year, let's call her Sarah, a consultant making around $120,000 annually, she was reporting nearly all of that $120,000 as taxable income. She had formed her LLC correctly, but she wasn't taking advantage of deductions that would have dropped her taxable income down to roughly $85,000. That's a difference of about $35,000 in taxable income. At her tax bracket, we're talking around the 24% bracket, which kicks in at $100,525 for single filers in 2024. That's nearly $8,400 in federal taxes she didn't need to pay. And that doesn't even include self-employment tax savings. So how did we fix it? Let me walk you through the layers. First, there's the home office deduction. I know, you've probably heard this one before. But here's what I've seen. Most people either don't take it because they think it's too aggressive, or they take a tiny deduction that barely scratches the surface. The IRS allows you to deduct either $5 per square foot, simplified method, or your actual expenses, regular method. If you have a 200 square foot home office, that's $1,000 per year on the simplified method. But with the regular method, you're deducting rent or mortgage interest. Utilities, insurance, depreciation, repairs, it adds up fast. For Sarah, her home office was about 150 square feet. Using the regular method, we deducted roughly $3,200 annually. That's $3,200 that doesn't count as business income. But that's just the start. Second, there's vehicle and mileage deduction. The 2024 standard mileage rate is 67 cents per mile for business use. If you drive 15,000 business miles per year, which is totally reasonable if you're meeting clients, traveling to jobs, or managing multiple locations, that's $10,050 in deductions, straight up. But I've worked with dozens of LLC owners who track maybe 3,000 miles per year because they didn't realize the IRS expects documentation. Third, and this is critical, there's the retirement account strategy. Most people know about 401ks. They know the limit is $23,000 for 2024 if you're under 50. But here's what I see constantly. They think that $23,000 limit applies the same way to everyone. It doesn't. If you're a solo LLC owner or you have your own C-corp election, you can contribute to a solo 401k. And with a solo 401k, you can contribute as both an employee and as an employer. That means you can put in the $23,000 employee deferral, plus up to 25% of your net business income as an employer contribution. I've had clients max this out at over $69,000 per year. That's not hypothetical, that's real. That's $69,000 that never touches your tax return. I worked with a client last year, a freelance designer making $180,000 from her LLC, who opened a solo 401k in March. We calculated her employer contribution based on her net income, and she put in $62,000 total for the year. that $62,000 reduces her taxable income from $180,000 down to $118,000. At the 24% bracket, that's $14,880 in federal tax savings right there. Plus, she's saving for retirement. But wait, there's more. If you have employees or you want additional tax-deferred savings, there's also the SEP IRA option. With a SEP IRA, you can contribute up to 25% of your net self-employment income, capped at $69,000 in 2024. Or if you're looking at health insurance costs, the HSA is absolutely underutilized. If you're self-employed and you have a high-deductible health plan, you can contribute to a health savings account. For 2024, the family coverage limit is $8,300. That's pre-tax money, it grows tax-free, and if you use it for qualified medical expenses, it comes out tax-free. It's the only account that gets triple tax benefits, and I see business owners skipping it constantly. I had a client with a $6,000 deductible health plan for his family. He was eligible for an HSA. He had never opened one. We got him set up with an $8,300 contribution for 2024. That's $8,300 that doesn't show up on his tax return. If he doesn't spend it, it grows in the account. It's basically a hidden retirement account that the IRS lets you use for medical expenses. Now let's talk about the qualified business income deduction, what we call the QBI deduction. This is Section 199A of the tax code. If you're a pass-through entity like an LLC, you can potentially deduct up to 20% of your qualified business income, not 20% of your revenue, 20% of your QBI. Here's the reality. The way you structure your LLC, the deductions you take, and your total income all affect how much QBI you can claim. I've seen situations where proper deduction strategy essentially created an additional 20% tax savings layer on top of everything else. Let me give you a concrete example. I reviewed a client's situation, a service-based business owner with about $150,000 in net income from his LLC. If he took no strategic deductions, his QBI would be $150,000, and his QBI deduction would be about $30,000. But when we implemented the full strategy, home office, vehicle deductions, solo 401k contributions, and health insurance deductions, we reduced his net income to about $95,000. His QBI deduction dropped to $19,000, but his overall taxable income dropped by a larger percentage because we eliminated tax at multiple layers. That's how this works. It's not about gaming the system. It's about understanding that every deduction doesn't just reduce your tax once. It reduces it across multiple calculations. Here's something else I've seen cost business owners serious money. They don't understand the difference between a disregarded entity, a partnership, and an S-corp election. Default LLC taxation is pass-through, but you can elect to be taxed as an S-corp. Should you? That depends. If you're making solid income and you have self-employment tax exposure, an S-corp election can save you real money. I've worked with clients where the S-corp saved them $8,000 to $15,000 per year just on self-employment tax. But here's the catch. You have to run payroll. You have to pay yourself a reasonable salary, and then you can take distributions. The distributions aren't subject to self-employment tax. That's where the savings come from, but you have to do it right or the IRS will reclassify everything. The standard deduction for single filers in 2024 is $14,600. For married filing jointly, it's $29,200. If you're self-employed through your LLC, you can deduct 50% of your self-employment tax. That's a line item deduction that most people miss. Not huge, but it adds up. And if you're buying equipment or vehicles for your business, there's Section 179 expensing. You can deduct up to $160,000 in equipment purchases in 2024 in a single year. That's not depreciation over 5 or 7 years. That's a full write-off in the year you buy it. I've had clients buy office equipment, computers, furniture, and vehicles and deduct the entire amount immediately. The key is understanding that an LLC is a vessel. The tax benefits come from what you put inside it and how you structure your activities. I've seen entrepreneurs pay $5,000 to set up an LLC and then pay $12,000 in unnecessary taxes because they didn't understand the structure. I've also seen entrepreneurs file their LLC with almost no upfront cost and save $40,000 in taxes in the first year because they understood the deduction layers. Here's my final piece of guidance. This isn't about being